On a quiet morning in 2020, millions of people woke up, grabbed their phones and checked their stock apps. Red everywhere. Markets were crashing, businesses were closing, entire cities were shutting down. It felt like the end of something. But what most people didn't realize was this. It wasn't just a crash. It was a rule change. And most people missed it. For over 100 years, the economy followed patterns. Booms, busts, recoveries, inflation, recession, repeat. The Great Depression taught us what happens when speculation runs wild and banks collapse. The 1973 oil crisis showed us what happens when supply gets squeezed. The 2008 financial crisis exposed what happens when debt grows faster than reality. Each crisis felt different, but the basic rules stayed the same. Until recently. Because now the foundation itself has shifted. And if you still think the economy works the way it did in 1995, or even 2015, you're playing a new game with old instructions. Let's talk about what changed. Rule 1. Money is no longer scarce the way it used to be. There was a time when money felt solid. In the early 1900s, money was tied to gold. Governments couldn't just create more whenever they wanted. There were limits. Then those limits slowly disappeared. By 1971, the US fully left the gold standard. Money became fiat. That means it's valuable because we agree it is. For decades, central banks still acted carefully. They adjusted interest rates, they managed inflation, they moved slowly. Then 2008 happened. Banks were collapsing, the system was freezing, credit markets stopped working. So central banks did something unusual. They created money, trillions of dollars. Not by printing physical cash, but digitally with a few keystrokes. It was called quantitative easing. At first it was described as temporary, emergency action. Then it happened again. And again. By 2020, during the pandemic, money creation exploded at a scale never seen before in modern history. Stimulus checks, business loans, bond buying programs, near zero interest rates. Governments didn't just intervene. They flooded the system. Here's the shift. Before, money supply growth was cautious and slow. Now in crisis, it expands instantly. That changes everything. Because when money becomes easier to create, assets inflate. Stocks rise. Real estate rises. Crypto explodes. Art, collectibles, even trading cards surge in price. Why? Because when cash loses purchasing power, people move into assets. The economy didn't just recover after 2020. It transformed into an asset-driven machine. If you owned assets, you got richer. If you only earned a salary, you likely fell behind. Rule 2. The stock market is not the economy. This one confuses people. In March 2020, millions lost their jobs, small businesses collapsed, entire industries froze. But by August, the stock market had fully recovered. Think about that. Main Street was hurting. Wall Street was celebrating. This disconnect shocked people, but it revealed something important. Stock markets don't measure suffering. They measure liquidity and future expectations. When central banks inject trillions into the system, much of that money flows into financial markets. Large corporations can borrow cheaply. They can buy back their own stock. They can automate faster. They can consolidate competitors. Meanwhile, small businesses don't have the same access. So the market rises. But everyday life feels harder. That's not a glitch. That's a new feature of the system. The economy became financialized, meaning financial markets gained more power than the physical economy. And if you don't understand that shift, you'll keep waiting for the market to reflect reality. It doesn't. Not the way it used to. Rule 3. Debt is no longer the villain it once was. In the past, high debt was terrifying. After the Great Depression, people feared borrowing too much. After 2008, debt was blamed for collapse. But something strange happened in the 2010s. Interest rates stayed near zero for years. When borrowing is cheap, debt feels manageable. Governments realized they could run massive deficits without immediate collapse. Corporations realized they could borrow billions to expand, buy competitors, or buy back shares. Even individuals got used to cheap mortgages, auto loans, and credit. Debt stopped feeling dangerous. It felt normal. In fact, the entire global system now depends on debt growth. Why? Because modern economies grow through expansion. Expansion needs capital. Capital often comes from borrowing. Here's the hidden rule. If debt stops growing, the system slows sharply. That means central banks are now under pressure to keep borrowing affordable. But that creates another problem: inflation. And that brings us to the next rule. Rule 4. Inflation came back and it changed behavior. For years, inflation was quiet. From 2010 to 2019, prices rose slowly. Central banks even struggled to increase inflation. Then 2020 happened. Supply chains broke. Factories shut down. Shipping costs soared. Governments injected massive stimulus. Demand surged. Supply couldn't keep up. By 2021 and 2022, inflation spiked to levels not seen in decades. Groceries cost more. Rent surged. Gas prices climbed. Everyday life became expensive. For younger generations, this was new. For older generations, it felt familiar. But here the key shift. Inflation changes psychology. When people expect prices to rise, they act differently. They buy sooner. They invest faster. They demand higher wages. They avoid holding cash. This accelerates economic cycles. Central banks responded by raising interest rates aggressively. And suddenly, the era of free money ended. But something deeper had changed. People no longer trusted stability. They understood how fast things could shift. That awareness reshaped financial behavior. Rule 5. Technology became the core of the economy. In past recessions, factories slowed. Today, servers hum. Technology companies didn't just survive the pandemic, they expanded. Remote work exploded. E-commerce surged. Digital payments became standard. Artificial intelligence accelerated. The economy became more digital than physical. That changes wealth creation. In 1929, wealth was tied to factories and railroads. In 1973, it was tied to oil. In 2008, it was tied to housing. Today, it's tied to data, networks, and software. A small team with code can build $1 billion company. A viral app can generate more revenue than a manufacturing plant. Scale became exponential. Technology concentrates wealth. Digital platforms benefit from network effects. The biggest players dominate markets. Winner-take-most becomes normal. That widens inequality. But it also creates new opportunities. The rules for success shifted from physical labor to leverage. Leverage through software. Leverage through media. Leverage through capital. If you understand this, you can adapt. If you don't, the gap widens. Rule 6. Globalization is no longer guaranteed. For decades, globalization seemed unstoppable. After the Cold War, trade expanded. Manufacturing moved overseas. Supply chains became global. It made products cheaper, but it made systems fragile. The pandemic exposed that fragility. When factories in one country shut down, entire industries stalled. Semiconductor shortages hit automakers. Shipping delays stalled retailers. Medical supply shortages revealed dangerous dependencies. Then geopolitical tensions increased. Trade wars, sanctions, strategic decoupling. Countries began prioritizing resilience over efficiency. That means more domestic manufacturing, more diversification, higher costs. The era of ultra-cheap goods may not return the same way. Rule 7. Attention became currency. In today's economy, attention drives value. Social media creators build businesses from audiences. Brands compete for clicks, not shelf space. News cycles move markets in minutes. A tweet can erase billions in market value. A viral post can create a new brand overnight. Today, narrative matters just as much as capital. Information moves instantly. The people who understand media dynamics have an edge. Rule 8. Work is being redefined. Get a job. Work 40 years. Retire. That model is fading. Gig work expanded. Remote work normalized. Freelancing increased. AI began automating tasks once considered safe. The economy now rewards adaptability more than loyalty. So what does this mean? It means the economy didn't just go through a rough patch. It evolved. Money moves faster. Information spreads instantly. Debt drives growth. Assets inflate quickly. Technology dominates. Globalization is shifting. Work is changing. If you're waiting for things to go back to normal, you might be waiting forever. This is normal now. Crashes happen fast. Recoveries are uneven. The biggest wealth transfers happen during transitions. And we are living through one right now. The rules changed. Most people missed it. Now you don't have to. The next economic shift won't come with a warning. It never does. So if you want to understand what's coming before everyone else does, subscribe now. Because the next rule change is already forming. And we're going to break it down.